Hey folks, this is Clayton Collins, your host for the Housing News Podcast. I'm also the CEO of HW Media, where I have the pleasure of leading HousingWire, Real Trends, Reverse Mortgage Daily, and Altos Research. At HW Media, we're focused on bringing real-time news information and industry data to housing professionals so they can make more informed decisions and help build a more sustainable housing market. Today on the Housing News Podcast, I have the pleasure of interviewing Kevin Parra, CEO of Plaza Mortgage. Kevin has a phenomenal track record and history in the mortgage industry. He's been in the industry since 1984 at a point where mortgage rates were significantly higher than they are today. So he has been through a cycle or two and understands how to navigate the mortgage market as it changes. But this market that we're operating in right now, with rapidly rising interest rates and inventory that's significantly lower than we saw over the last several years, has been challenging even for the best of operators. Kevin gives us a glimpse into some of the strategies that he is employing as we start 2023 and plan for a year where we don't know exactly where rates are going. We don't know exactly what volume is going to be, but we know that we need to continue to serve homeowners and run efficient mortgage banking operations. Kevin is highly focused on recruiting the best account execs and building a culture at Plaza that recruits and retains the best mortgage professionals and provides them with impressive and efficient technology tools. Kevin gives us a view into those strategies in today's conversation. I hope you enjoy this conversation with Kevin Parra, CEO of Plaza Mortgage. All right, Kevin, thanks for joining us for an episode of Housing News.
Sure, Clayton.
So, Kevin, this conversation, I always try to recruit great mortgage executives to join us for the show, and particularly executives that have been through a few cycles. And I know you've been in the business since 1984. So a lot of the challenges that we're seeing today, while they have a new flavor and maybe a little more pronounced than some of the cycles and challenges we've seen in the past, you have some experience navigating. So tell us a little bit about your history in the mortgage ecosystem, and since you started in 84.
Well, when I started in 84, fixed rates were like 17%. And I was selling 11% option arms as a loan officer. And I thought it was great because I didn't know any better. I had just gotten out of college.
6 points lower than the 30-year fix. That sounds like a great product.
Yeah, it was. So, it really comes down to, what is a good market? What's a bad market? And, I thought it was a great market because, the competition was in balance with the amount of volume that was out there. And so I did well in that market. And over the years, I've seen, the changes in market up and down. We're a very cyclical industry. And, the really most important thing is whether or not there's a balance between supply and capacity. And I've never seen such a radical disparity between supply and capacity as I have today. Most of the large firms that have the biggest market share are down anywhere from 50 to 70%. And yet employment in the mortgage industry is down 15%. So we're still have a massive capacity issue, and it's making that very difficult for mortgage companies such as myself and many others to do well in this environment.
So this isn't the first, we're in the back end of what's not the first refi boom that either of us have seen in the mortgage industry, particularly in over your years of experience. So how has the industry adjusted to the back end of refi booms in the past? And why is this disparity between capacity and demand so much wider than what you've seen at other points in your career?
Well, I think it's the speed in which it happened. Inflation after COVID took off highest it's been in 40 year. And that caused the Fed to raise rates as fast as they lowered them during COVID. And that's really caused, quite an impact on both the mortgage market and the housing market. Who would leave a 3% mortgage to move into a 6% mortgage? So that's really frozen up a lot of the housing market. Unless someone dies or gets divorced, they're probably not going to move. And the relocation issue has really kind of been extinguished by everyone working from home. So I think that's really created a steep drop in demand, which I've never seen in my career.
Yeah, so back at the end of December, I think it was like the 28th or 29th, one of our reporters, Flavia Furlan Nunez, published an article talking about 2023 strategies. And she interviewed you for that article. And two of the points that you referenced as part of the challenge that we're facing right now are homebuyer psyche and affordability. So when you talk about homebuyer psyche, are you talking about that mortgage rate lockdown kind of dynamic that you just mentioned, or the other components which might influence how homeowners are thinking about, or potential homeowners are thinking about, the housing market today?
One of the biggest issues is just affordability. When you have home prices holding, for the most part at all-time highs, and then you have mortgage rates all of a sudden doubling, it really creates an affordability issue for a lot of folks. And that there's ways to work on that, but it's going to be an issue for a while. And not to say that rates are where they are today are like high historically. They're actually quite low. I remember if you can get a 6% rate, that's crazy. It's so good.
I mean, your career in the industry almost matches up perfectly with this multi-decade decline in mortgage rates that we've seen over the last 3 decades.
Pretty much. And so, yeah, that's kind of the shocker is having rates double in a very short period of time. And housing prices were pushed up because of low rates over that entire time, because of how much you could buy with based on a 3% mortgage or a 4% mortgage. You can afford a lot more, and now all of a sudden, it's a 6% mortgage or a 5.5% mortgage, and affordability is a real issue. And I think it's going to take a long time for that balance to get there again.
So one of the things that it seems like the Fed has their sights set on is reducing wage inflation, which is a driver of other inflationary categories. Wage inflation is one of the things that actually could realign home prices and affordability, but it seems like the Fed's set on achieving that a different way by pushing home prices down through higher rates. Do you think that we have further to go and where home prices may realign or readjust to the current wage levels in certain markets?
I think, again, that's going to take quite some time because there's not really a huge need to move for most people these days, with relocation not being an issue. As I said before, it's pretty much death and divorce are kind of reasons why people sell their house or are forced to sell their house. And wages to catch up to a doubling of rates would take a lot of increase in wages, which the Fed is actually trying to not have happen, because wage inflation is something that is from an inflation standpoint very sticky. Wages typically don't go down after they've gone up. They're not volatile like food and energy. So the Fed is basically doing their best to tamp down inflation, but I don't know that they have the right levers to be able to do that given the current environment post-COVID.
Yeah. So, okay. So before we, kind of go deeper into how you're steering your organization to navigate this market, can you give us like an overview of Plaza, the business lines that you operate and your major focus areas?
Well, we've always focused on mortgage broker. That the TPO has been our business model since we opened the company in 2000. We added correspondent lending about 10 years ago, as it was a good complement to our being a TPO lender. We've always steered away from retail. That's not our strength. It's always been TPO. I had a lot of experience in correspondent lending in my career as well as wholesale, and so it made sense. And we just feel like you got to be really good at what you're doing, and you can't be good at everything. And we're really good at third-party lending, and so that's been our focus, and will continue to be our focus.
Nice. So I think overall wholesale and TPO has had a strength in the purchase market. And over the last 2 years, or a little bit longer than that now, we saw this incredibly strong refi market. How did that market dynamic impact your origination mix? And were you able to maintain a stronger purchase lens through the broker network than, maybe some of your retail counterparts?
Yeah, I mean, since we don't have in-house, retail calling, for refis, it, the the decrease in refis had way less effect on us than it did, the consumer direct guys who really relied on nothing but refis. Whereas, our broker clients, they've always been referral based for the most part. I mean, there are some big brokers that did do consumer direct, but they weren't our brokers because uh, our whole focus is in helping our customers figure out how to get deals done. And those aren't refinances, those are purchases. Refinances are pretty easy. And purchases can be far more complicated and also require different products to make them work. And that's been our expertise always from the beginning. We've always focused on the purchase broker, and it's paid off from a standpoint of us having a less of a drop in volume than some of the others that have big consumer shops.
Yeah, that's a positive thing. Despite I know purchase volume is had its challenges too, particularly with low inventory and affordability issues. But definitely a positive not to be coming down off of the mountain of refi. And as an operator, and I definitely don't operate a mortgage lending shop, but a media and data business in the housing industry, I find we have parts of our business where I need to exercise extreme caution from a cost perspective. Other parts of the business where it's time to put our foot on the gas and be more aggressive with recruiting the right people or certain marketing initiatives or product initiatives. How do you think about your business as you enter 2023? Are there areas where you kind of have to, wear two different hats at the same time, like the cautious hat, but also the how do we gain market share through this environment hat?
Oh, yeah, 100%. So we've had a great opportunity from a standpoint of recruiting because a lot of companies that were wholesale and retail have chosen to exit the wholesale channel, which has been, a phenomenal opportunity for us. And as far as, wearing the other hat, obviously we have to make sure we are the right size company for the amount of volume that's out there. We're 90% purchase, so everything that we're going after is going to be just pure market share. So using technology to become more efficient, to enable us to price where we're in the hunt, and yet still have the expertise, the salespeople that can go out and really figure out how to make deals work for our customers. I mean, that's really the name of the game for us.
Outside of the focus and track record in wholesale, are there other reasons why an AE who's coming out of a different organization may choose Plaza?
Well, I think the obvious reason is our tenureship. I mean, we've been around for 23 years. We've been through some pretty horrendous cycles, and we're still here. And there's not really too many pure TPO shops. I don't know if there's any that can say that. So we're obviously committed to third-party lending, while others, bigger companies, public companies, have discarded it along the way several times. It's not it's not like it's just been once. Like they come and go. So for someone who wants a career in being an account executive and growing that career into management, I think that's a pretty big reason for them to think about Plaza. In addition to that, obviously our product offering has always been broad, which helps us through various types of purchase markets, whether it be needing renovation lending or whether it be just buy downs. We're very strong in FHA, which is typically your first time home buyer, which is where a purchase market starts. So yeah, I think there's a pretty big value proposition for an account executive to consider Plaza as a destination employer. And our tenureship also has a lot to say to people looking at us. Is we've had people with us for a very long time. I mean, most companies, their account executives are 2 years and then 2 years and 2 years, whereas we're more like 5 to 10 years. I mean, it's pretty impressive, I think, relative to our competitors.
Yeah, that definitely is a differentiator. So it feels like if we kind of rewind to some of the pre-COVID years, there was a period where with IMBs, it was relatively in vogue to be able to sell the story of multi-origination line diversification and having the retail, consumer direct, TPO channels all humming together. I'd say if there's a trend that I feel like is emerging right now, partially by necessity, partially by focus, is more single channel focus, or lenders really starting to, even if they have multiple lines, like raise their hands and say, hey, we're TPO first, we're retail first. Do you think that's a trend that's emerging, or maybe a false signal that I'm seeing?
No, it's 100% a trend. I mean, if you see how many guys have exited TPO, I call that a trend.
Yeah. And that, I mean, I don't know if that was like exiting TPO was like, hey, we're, and yeah, that was partially by necessity, right? Like there was people that were getting it handed to them by folks with like single channel focus.
I'm not sure I'm following what you're asking. Sorry.
Oh, I mean, like some of the lenders who exited TPO, it wasn't, I mean, that was by necessity. Like they weren't winning in that channel and needed to focus in on somewhere where they had a shot to win.
Yeah. And I think it goes back to, again, focus on what you're really good at and make sure you succeed there. And it's hard to be good at, different channels because they're very different. The reason why we're really good at correspondent is because it's a good complement to wholesale. But retail is a completely different animal.
So in talking about the focus on wholesale, so we've definitely heard organizations like AIM and NAM and UWM and other lenders that are wholesale focused talk about growth in the broker channel and like growing the pie and seeing more brokers, more originators turn from the retail channel to the wholesale channel. Is that a trend that you're seeing and something that like you're making a bet on?
So if you look at the primary secondary spread right now, it's running anywhere from 130 to 150 basis points. Whereas, in the wholesale channel, we're not seeing anything close to that. So pricing for brokers is definitely far better than pricing for your retail loan officers. And that's a pretty big competitive advantage right there. And a retail shop has got overhead that is far exceeds a mortgage broker shop. So the combination of a broker and a wholesale lender is going to beat, in my opinion, the price and product availability and execution over most retail mortgage lenders.
Yeah, that makes a lot of sense. So you think so as we enter like a much more purchase focused market, that might be the biggest understatement of of the podcast. We keep hearing a larger emphasis on originators and lenders wanting deeper relationships with their realtor partners. If the wholesale channel is delivering a pricing model that has advantages over retail, are brokers doing an effective job at telling that story to their agent partners, or like what has to happen from an awareness perspective to really to leverage that advantage?
Well, I don't think that price is something that they should be really focusing on. I think that is self-evident. Consumers tend to shop because it's pretty easy these days online to shop to see if they're, whoever is offering them a particular rate it's reasonable, it's in the hunt. I think what they really need to focus on with their partners that are referral partners is what they can offer as far as getting a deal done, because that's the biggest thing. I mean, realtors care most about the transaction closing, and that is what they really need to focus on, is showing their partners how they can get the deal done, whereas maybe the guy at the retail shop can't, based on product alone.
But affordability like plays a role in deals closing, and I think that's where rate matters. We keep hearing, it's been going on for 4 or 5 months now, but people talking about buy down programs. I even saw a developer of New York City condos this week whose developer is doing a 3% buy down program. Do you think those buy down programs have legs and are serving their intended purpose?
Oh, for sure. I spoke to another publication, I believe, about buy downs and how important they are in markets like this. If you think that, we're probably at the top or getting close to the top of where rates are going to be, if you can lower your rate 2% and then 1% over the next 2 years, and then refinance, that's that's a far better option than trying to get a price concession for the property you're buying. And that's, builders have known this forever, and that's one of the one of the things I did do in my past career is I was a builder rep, calling on builders, and buy downs were normal. And I know there's a tremendous amount of use of them in today's market by builders, and we're obviously pushing that out to our broker customers that, especially ones that have not been around as long, that are unfamiliar with the product. But it's not really a product, it's just it's more of a strategy. Yeah. So yeah, no, buy downs are really becoming a bigger part of the market. And I think they really serve both the consumer and the seller, whether it be a private seller or a builder, quite well.
Yeah. So let's shift over to kind of some of the national market data, and I'd love to hear kind of what you're seeing in your business. So rates have been over 6% most of the year. I think we saw one read where they dropped to a 5 handle for a hot minute before we got a hot jobs report. But kind of despite that, we are seeing some positive traction and applications from the MBA survey. This last week, we saw a 3% week over week increase, which is, starting from a small base. So 3% isn't huge, but I am hearing a lot of anecdotal evidence from originators and IMB execs where they are seeing a pretty massive shift in the volume they saw in November and December, overall Q4, to kind of how Q1 is starting out. What's your sense on how Q1 is starting out, and how is that impacting your strategy for 2023?
Well, the good news is it has started out much better than the end of last year, especially even since January. We've seen quite a pop in originations, and that's obviously a positive sign. Whether or not that continues, based on where rates are going, which appear to still be going up again, we'll have to wait and see. I certainly have learned long ago not to try to predict where interest rates are going, other than until maybe tomorrow. That's about it as far as, I think the important thing is, when you're looking at your strategy, is you have to be nimble. So regardless of what rates do, you have to be ready to adjust quickly. And, that's what's benefited us over the years, is being nimble, being able to adjust quickly, not having a very, large management structure. I mean, we're very thin when it comes to, our org chart. And I think that benefits us because we know what's going on, pretty much right away. And, to be able to make decisions based on current information is really important in markets like this, where the volatility is quite high.
Yeah, earlier, we talked about mortgage shops kind of getting the right kind of staffing and expense structure for the current market demand. And that's one of the parts of this market dynamic that I think is most frustrating, is we can't make predictions for full 2023 volume. We can't predict where interest rates are going to be. But today, lenders need to make decisions about how they're going to staff and prepare their organizations for the remainder of the year. We know we can't ramp up ops processing and underwriting overnight if we see interest rates come back into an area where people start to transact at a higher volume. Earlier, you mentioned technology. Do you see technology as being a tool that helps you be more elastic, or, is it still a pretty, have it in the back of your head that you might need to ramp hiring in certain areas if the market cooperates?
Well, technology for sure can make you more elastic. I mean, we've employed a lot of technology in the past 6 months, even whether it be bots, which basically do mundane processes that nobody really wants to do anyway. That can be far more efficient at getting things done, or whether it be just better presentation of how the system looks to our customers. I mean, we went from having to do webinars on how to use our system to where somebody starts a training and they're like, no, I got this is obvious. So it's doing things like that, I think, really make a difference as far as being able to ramp things up quickly when necessary. Your technology has to be easy to use. It has to be efficient and nimble. And we make changes when necessary. And as far as just staffing, I mean, it's always been in my entire career. You have the sales side that is extremely optimistic about how much volume they're going to do this year, even though they have no idea what's really going to happen with interest rates. And then you have the corporate side that's saying, hey, we got to staff appropriately. So that tends to create a situation where lenders don't adjust fast enough. And that's been an age-old problem that I'm familiar with. So I'm like, well, let's staff for what we did right now, because we can probably get people back if we need to, but we can't afford to just bleed because we're overstaffed.
Yeah. So Kevin, we started the conversation talking about consumer psyche, but I think you're starting to point to like the importance of talking about like mortgage professional psyche. And like
Yes.
we get that sales orgs and across all industries, it's not just it's mortgage originators like have a tendency to be over optimistic, and like you can put that in a negative light, but it's also a really important mindset. Like the last thing you want is an originator and like in their own head in a downward spiral negative about like what their outcomes for 2023 might be. That just becomes a self-fulfilling prophecy. So on the sales side, how do you manage mindset and make sure your team is focused in the right places?
Well, fortunately, I have a really good management team who does that for our account executives, and hopefully they push that out to our customers. It's funny, I just had a guy who's a regional manager in the West, and he wrote to his account executives that work under him how he was really kind of down about just everything that's going on, and it was just kind of everything's gloom and doom. And then he went out to lunch with a guy that he really respected and found like a bunch of positive things that really kind of turned his mindset around. Like, wow, we actually have a huge opportunity here. I mean, things like renovation lending, that where you look at America's housing stock and how much it needs work, and that's an opportunity to where people can see and like, wow, I can buy a house for 200,000, put 20,000 into it without additional cash outlay through renovation lending, and have a house worth 250,000. So I mean, that's things like that. Keep people like positive that there is opportunity out there, and it's not all gloom and doom. And again, like I said before, rates are actually quite good. It's just waiting for the balance between prices and rates to get more equalized. And without people moving and having to sell, it's going to take a while. So in the meantime, you got to focus on the things you can do.
Yeah. So how do you, so stepping away from like sales leadership, like are there your other leaders in the organization? How do you focus them on the things that they can control versus the things that are outside of your control? And I guess I'm specifically, thinking about operations leadership, capital markets leadership, technology leadership, who might be feeling like they have less control over the direction the ship is headed in today.
Well, I think it really comes down to is efficiency is what you need to focus on, and everyone knows that in our organization. Anything they can come up with to make us more efficient in basically producing loans is going to help us, and anything that's inefficient has to be extinguished. So that's kind of like the mantra of everyone in the organization, is driving toward efficiencies and making the user experience, being our customers' experience, as well as our internal customers, to be the best it can be, given what we have to work with. And that's what our focus is, always.
As CEO, have you developed any tactics for rewarding that focus, or rewarding your team members for thinking about efficiency and like the activities that we know help the organization and help the longevity and long-term trajectory, but often come with some short-term pain? Like, how do you reward and recognize like what some of those leaders are doing today to help steer your business toward success and market share growth?
Well, from a executive standpoint, obviously the reward is you're in bonus.
Yep.
We financially reward executives, but as far as people further down the line, we have things like a rewards and recognition program where people can get nominated to that, that they're a MVP, most valuable player, and they by earning that MVP status, they have an opportunity to join us on our annual awards trip. So, we look for things always to be able to just, whether it be a pat on the back, through sharing it with the organization, letting everybody know that, hey, this person did an amazing job. Or whether it be, at the end of the year, we decide who is the most influential in the organization, and they join us on our annual sales trip, which are usually to very nice destinations. And, I think that's kind of been something that we've always been pretty good at. And, we ourselves do internal surveys done by an outside agency, so that everybody can feel comfortable about speaking freely and asking them questions about, what they think of the organization, and, what they think of, who they're working for. And our response rates have been north of 85% most of the years we've done them. And we really get an idea as to whether or not people are happy. And the overall happiness of our associates obviously reflects on how they do their job, how they interact with our customers, I mean, everything. So fortunately, we've done a really good job in that area. And people are very satisfied. And that's probably a reason why we have such great tenureship at our company. We have very, very little turnover.
Is there anything that stands out to you over the years through those surveys that has surprised you, or you've learned, or that you've taken and implemented change with? Like, anything that stands out that you've learned from your team?
Actually, I mean, maybe health benefits, something like
Okay.
that. They should have better health benefits, and we're like, well, we had to point some things out that we actually really have really good health benefits. But as far as other surprises, not really, because if you really have your pulse on your company, you really shouldn't have that many surprises.
Yeah, absolutely. So we talked a little bit about what to anticipate in 2023, and we know we're not here to shake the crystal ball. We don't know what's going to happen exactly with interest rates. It'll be one economic report to the next. But as the industry's talked a lot about some of the trends that will emerge with uncertainty, one of those has been consolidation. We talked about people exiting channels, but there's also M&A. So as we look forward to 2023 for Plaza, is there anything that you're changing strategically? Are you thinking about recruiting differently, or M&A differently, tech investments differently? Like what's one thing that might surprise us if we look back at the end of 2023 that Plaza really focused on?
Well, M&A has never been part of our deal. I mean, we've always been organically grown. We feel that served us well over 23 years. There's one company that bought a wholesale company and closed them shortly thereafter. I'm not going to name names, but it's pretty significant.
I think you can search HousingWire.com for that answer.
Yeah, pretty much. So, that's never been part of our deal. Our deal is, we feel that we have a great platform that attracts strong people, and that served us well over the years, and we'll continue to do that and continue to build on that platform through using technology and processes that, constantly searching for process improvement, best practices. And, that's pretty much the same thing we've been doing since the beginning. And so there's not really anything that's going to change with Plaza this year other than constant search for improvement, which I think we've done pretty well at.
The Kaizen methodology, continuous improvement. I love the focus, Kevin. Thanks so much for giving us a glimpse into your business and the way you're thinking about 2023. Really, really appreciate the time today.
Sure. Thanks for having me.